I want to start and get this out of the way with the elephant in the Richmond Fed computer room. Last week, the Fed payment system went down for about 4 hours. And traders want to know what happened and how vulnerable are we to this happening again?
It was an internal issue. I think we've described that. And it was an operator issue. It got fixed and it's back up and running.
And is this something that's likely to happen again? There have been calls to let the private sector have an even bigger role in the payment system. Does this undermine the Fed's argument that it should be the main payments master?
Oh, no, I don't think this one's going to happen again. That we've figured out. And, you know, these things do happen. Systems do click up and click down. I think we've addressed this one.
All right, ISM manufacturing, I want to get to that today. The headline, the highest in 3 years. Employment, the highest in 2 years. Prices paid, the highest since 2008 when the PCE index was over 4%. But what struck me among all that were the comments from manufacturers. And you have people saying, like, things are now out of control. Everything is a mess, and we're seeing wide-scale shortages. Labor shortages at suppliers are affecting material delivery and prices. We are so overloaded with orders and do not have the personnel to get product out the door on schedule. Prices are rising so rapidly that many are wondering if the situation is sustainable. Are we overheating in manufacturing? Should we be worried about implications for growth and inflation?
Well, as I've been on the ground in my district talking to manufacturers, you do see this situation. A lot of them closed down for a couple months last year. When we came back, the amount of excess savings in people's pockets led to people rotating towards spending on goods. And so there's been a lot of demand. And frankly, they've been behind the curve trying to catch up. And, you know, when you're in a manufacturing shop, it's not as easy as saying, why don't you just open up another line? That takes a lot of money. It takes a lot of investment. It takes a lot of lead time. And so people have been, you know, working at 110%, but demand has just continued to be extremely strong for anything related to time at home, outdoor recreation, those kinds of expenditures. And so, you know, people are I hear the same thing you saw in that survey, which is the manufacturing sector is very busy and working hard to keep up. What that does for prices, I do think we're going to have price pressure in the fall, in the spring, because I do think we're going to have pent-up demand as vaccines are rolled out and warmer weather approaches. So I do think we're going to see that price pressure.
Well, some of your colleagues, including the chair last week, dismissed the bond market moves as basically a sign of confidence in the economy and said that the inflation moves we are expecting will be short-lived. But traders say it's not that simple, that yes, maybe at the longer end you have some of that, but at the shorter end, there's a lack of repo collateral. Overnight Treasury repo trading went negative on an intraday basis a couple times. Do you see anything in the markets that the Fed will have to address?
Well, I focus on some of the fundamentals. And, you know, if you talk about price pressure, as I said, we'll see that in the short term, not least of which because we're rounding over the next few months that were deflationary last year. So the 12-month numbers will look a little higher than normal. But inflation is a longer-term phenomenon. At its core, it relates to expectations and what people expect prices to be. And I have to say, as I'm speaking to businesses in our district, I'm not hearing a sense of overwhelming desire or intent to be escalating prices beyond normal levels. So I think we will see some pressure, but I do still expect the medium and long term for it to be moderated.
Well, I guess the question that arises in connection with that is, what about compensation? Yes, firms say they're raising prices because they're having to pay more for raw materials, but is anybody going to be raising prices in order to raise compensation because they're having trouble attracting employees?
Well, you do have this mismatch in the employee base. You've got a lot of folks out of work, unprecedentedly large number. They tend to be focused in these personal contact service industry jobs, waiters and waitresses, housekeepers, and the like. And then you've got a lot of employers who are short-staffed. They tend to be more in technology and manufacturing and construction. And so you do hear cost pressure, comp pressure in some of those sectors. But by the same token, you obviously don't hear it in those personal contact service sectors. And I think one of the interesting challenges for the next 6 months is going to be how many of those personal contact service jobs come back. For the ones that don't come back, how redeployable, how retrainable those folks are for the jobs that are available. And so we'll have to see how the net of that plays out.
I want to see if you can connect the dots for our viewers and listeners. There is a mismatch that may drive some wages higher. We are seeing some prices higher. You have a relatively strong forecast for the spring and summer. Is the market fixation on inflation inconceivable, or is it misplaced?
Well, like I said, when you think about inflation, you got to think about expectations. And so I watch carefully both survey and market-based sense of inflation expectations. And those metrics are up from where they were 6 months ago, but frankly, still short of where our targets would suggest they should be. And so I haven't yet seen the indicator that expectations are moving out of line with a reasonable range.
I guess the underlying question is, because you're with the Fed, is with the yield curve steepening as it has, and the short end getting very short and the long end rising quite a bit. Folks at Bank of America, for example, your neighborhood bank, say you're losing control of the yield curve at both ends. And I'm wondering if you see that, or if you have any concerns that interest rates will affect decision making out in corporate America.
Well, I think we obviously have control of the yield curve at the short end. And at the longer end, I think when it moves, it depends a lot on the driver. If the driver is normalizing inflation expectations, that's welcome. If the driver would be, which it hasn't been so far, elevated inflation expectations, that would be worrisome. If the driver is, as it seems to be, news about vaccines or news about health of the economy or news about fiscal stimulus, then I think it's a natural reaction. And at these level of interest rates, when I talk to businesses in my district, I do not hear any sense that people are dialing back their investment intent.
There's also concern that there may be some over-levered companies out there. Do you see that in your district?
Well, there's certainly over-levered companies in my district and in every district. I'm not seeing, though, anything that seems like an outsized level of financial distress, at least not at this point.
A question that John Farrow asked me this morning. Are you more concerned about bond market volatility or about the markets pulling forward the date of a Fed rate move?
I'm mostly concerned about the labor market and this mismatch that we've talked about. GDP at the end of the year was 2.5% down. Employment was 6.5% down. And a large part of that reason is these employment intensive industries like restaurants and hotels that aren't yet back to full thing. So I'm trying to focus a lot on the real economy, and the thing I'm most focused on is how are we going to support participation in the workforce? How are we going to support redeployment, the public health challenges we have in terms of getting people back to work? And I think that's the place that our mandate would suggest I should be focusing.
Well, the speed of the recovery is a key component of the market's questions, and there's an argument this isn't going to be like a normal recovery. This is going to be much, much faster. Do you agree with that?
Well, I think it already has been fast, at least on the GDP side. If you map this downturn versus other downturns, you'll see a much, much steeper drop, but the slope being much, much steeper on the way up. Again, we'll have to see on the employment side. I do think if we have good news on the public health side in terms of vaccines and cases continuing to come down as we go into the spring, that will be extremely positive for businesses and for workers. And then I think we're going to have to see where the economy settles on the back end of it. How many restaurants haven't made it, for example. And as I said earlier, people being redeployed into those occupations that seem to be hiring.
One of the things I think I criticize my own industry is unfair. Both market participants and reporters tend to say, well, the market is telling us this today, and the Fed is telling us something that they did 3 months ago at the last quarterly forecast that they made. And you can't really compare the two. So I'm going to ask you about March. Do you think your view of the economy, of unemployment, inflation, and where interest rates will be has changed since you last put out a forecast in December?
That's a good question. I don't think my forecast has changed, but I do think the uncertainty range has narrowed. And so if you go back to my last forecast, which was the second week of December, vaccines really hadn't been put out there. So there are questions of how fast could the distribution be? How effective could they be? And whether it's in the US, or you look at countries like Israel, it does look like they can be rolled out relatively quickly and they can be relatively effective. So I think that's one big change. A second big change in the forecast is the fiscal stimulus that was passed at the end of the year. When I did my last forecast, that was still uncertain whether it would happen. And the discussions that are happening right now about an additional stimulus. So both of those things, I think, have reduced the downside in the economy quite significantly. I do think, and I was hopeful, I think I'd say on those things, but again, there was a much wider range of uncertainty at that point than I think I see now.
Well, has the elimination of uncertainty changed your view on interest rate policy at all? The markets have brought in a tightening from 2023 to 2022. Would you think that is a fair possibility, or are we talking too far ahead to even know?
I think you're thinking too far ahead. Thank you for giving me that. No, look, we have outcome-based forward guidance. That's true on asset purchases. That's true on rates. I think it's as clear and explicit outcome-based guidance as we've seen. And I think the challenge for me, certainly, and maybe even the challenge for investors, is to not try to turn that into calendar-based guidance, but to say, well, let's see how the outcomes go. And, you know, we could have a great rollout of a very effective vaccine. There's still risks of variants and those kind of things on the other side. This pent-up demand, and the excess savings, which are in people's pockets, could be deployed quicker than I think they would, or maybe they'll be deployed somewhat more slowly. So I think we're just going to have to see how the economy develops. And I hope and think we've given pretty good guideposts in terms of how we'd react under different scenarios.
Well, one last quick question, because you mentioned asset prices. Are you concerned about asset prices at this point?
Asset prices on their own? Well, I think there's a lot that is rational. For example, on the housing side, supply has been constrained for many years. Demand was limited until just recently, but millennials are buying houses, and people who have been stuck at home have seen the flaws in their own houses and have decided to try to upgrade in a world where there's limited supply. So I'm not surprised to see housing prices go up. I let each asset class settle in its own place. And I'm trying to focus on unemployment and inflation.